Hey traders, welcome back. If you're trying to level up your price action or smart money trading, then market structure is the absolute foundation you need to get right. Because here's the truth. If you don't understand structure, every move looks random. But once you get it, the charts start talking to you. You'll know who's in control, buyers or sellers, and where the market might go next. So in today's video, we're going deep into market structure, what it is, how it works, and how you can start using it immediately to trade with clarity and confidence. Let's get into it. What is market structure? At its core, market structure is simply how price moves. That's it. It's the natural rhythm of the market. Price moves up, down, or sideways in a sequence of highs and lows. And once you learn to read these movements, you can start trading with the trend instead of against it. There are three core types of structure. 1. Uptrend. Price is forming higher highs and higher lows. 2. Downtrend. Price is making lower lows and lower highs. 3. Consolidation. Price is moving sideways, bouncing between levels. Once you know which structure you're in, your trading decisions become 10 times easier. Uptrend structure, buyers in control. In an uptrend, price pushes up, pulls back, then pushes up again. So you get a sequence of higher highs and higher lows. Every time price pulls back, buyers step in and push it even higher. Here's how it looks. Let's say price moves from here to here. That's a higher high. Then it pulls back to right here. That's a higher low. Then price pushes up to here, another higher high. This is a healthy bullish structure. So how do you trade it? You wait for price to pull back into a key area, like a fair value gap or a bullish order block, and then look for an entry around that higher low. Simple, clean, precise. Downtrend structure, sellers in control. Now let's flip it. In a downtrend, price keeps breaking down, forming lower lows and lower highs. Sellers are in full control, and every rally is just a chance to go short again. Example, price drops from here to right here. That's your lower low. It then pulls back to here. That's a lower high. Then it drops again to right here, new lower low. Again, clean structure. In this case, you'd wait for a pullback to a lower high and then enter a short, ideally at a premium level with some confluence like an order block or liquidity sweep. Consolidation. No trend yet now. Sometimes price doesn't trend. Instead, it just moves sideways, bouncing between support and resistance. This is consolidation, or what some traders call a range. There are no clear higher highs or lower lows, just choppy moves within a box. Here's an example. Price moves between here and right here for several candles, just back and forth. No breakout, no direction. When you see this, do nothing. Smart traders wait. They wait for a breakout, or even better, a liquidity grab, a change of character, and then a real trend to begin. Why market structure matters so much. Here's why structure is king. It tells you who's winning, buyers or sellers. It shows you where the market is heading. It gives you a map so you can avoid random trades, and it helps you find high probability entries and safe exits. Once you master structure, everything else becomes easier. Order blocks, fair value gaps, liquidity, it all starts to click. Spotting a shift in structure, the power move. Now let's get into the good part. How do you know when the trend is changing? This is where we bring in two powerful tools, change of character and break of structure. Let me explain. Change of character is your first clue, the early sign that the trend might reverse. Break of structure is your confirmation that the trend has actually changed. Let me give you two examples. Bullish shift. Example. The market is in a downtrend. You see lower highs and lower lows. Suddenly, price breaks above a previous lower high. That's your bullish change of character. Then price forms a higher low and breaks to a new high. Now that's your bullish break of structure. Now structure has flipped. The downtrend is over, and you're in a new uptrend. That's your signal to look for bullish setups. Bearish shift example. Now imagine the opposite. Price is in an uptrend, forming higher highs and higher lows. Then it suddenly breaks below the last higher low. That's your bearish change of character. Then price forms a lower high and drops even further. That's your bearish break of structure. At this point, you know the bulls are out and bears are in control. Your job is to find smart entries on the short side. Trends are made of multiple structure breaks. Trends aren't just one move, they're made of many breaks of structure. In a strong uptrend, you'll see price breaks a high, pulls back to form a higher low, then breaks the next high, pulls back again, and repeats. Each new break of structure confirms the trend is still strong. Each pullback gives you a chance to enter with confidence. Timeframe breakdown. Think like a pro. Here's how pro traders use structure. They read the higher time frame to understand trend direction. Then they use the lower time frame for sniper entries. Let's say the 4-hour chart is clearly in an uptrend. Then you drop to the 15-minute chart and wait for a bullish change of character and break of structure. Now you're entering a long trade in the direction of the higher time frame trend with a tight stop and high risk to reward. That's how you avoid fake-outs and bad trades. How to build a market structure-based system. Here's a step-by-step approach you can actually use. 1. Start with the daily or 4-hour chart. Identify the trend. Drop down to 15-minute or 5-minute. Look for a change of character. 3. Wait for a break of structure to confirm. 4th, mark your fair value gaps or order blocks near the structure shift. 5. Wait for a pullback into that zone. 6. Look for confluence like a liquidity sweep or internal shift. 7. Enter with proper risk management. That's how you trade structure like smart money. Mistakes to avoid with market structure. Here are the biggest mistakes I see. Forcing trades during consolidation, labeling highs and lows incorrectly, trading against structure because of emotion, ignoring higher time frame bias, jumping in without confirmation. Fix these and your entire trading game changes. Final thoughts. Structure is the real signal. Let's recap. Market structure is the backbone of price action. An uptrend means higher highs and higher lows. A downtrend means lower lows and lower highs. A range means no trend. Stay patient. Change of character gives you the early reversal clue. Break of structure confirms the new trend. Use higher timeframes for bias, lower timeframes for execution. Combine structure with confluences for the best results. This is how you stop guessing and start reading the market like smart money. Thanks for watching. If you want the next video on fair value gaps, liquidity sweeps, or internal break of structure, let me know in the comments. And hey, if this helped you out, hit that like button, subscribe, and stay tuned. More smart money breakdowns are coming soon.